Hi, it's Eric Nuttall of the Ninepoint Energy Strategies with our weekly update. News of the day very clearly is the fallout from Liberation Day, the imposition of retaliatory tariffs, which I would say, generally speaking, were significantly higher than what most people expected. I'll speak to directly what we think the impact is on energy and sentiment. More importantly, I think broadly speaking, economists are looking for a reduction, at least in U.S. GDP, of anywhere from 1 to 2%. So very, very significant. I think it's not a stretch of the imagination to assume that this will have an impact on oil demand growth. Now, at least we're coming from a position of strength. What we saw in January was very, very strong demand year over year in the United States, also hitting the highest in history for that time of year. At the same time, we do know the global inventories remain very, very low. I'll speak to perhaps why this gave impetus for OPEC Plus to do what they did as well. But for now, I think it's reasonable to lower one's assumptions on oil demand growth. Generally speaking, consensus was about anywhere from 1 to 1.2 million barrels per day for 2025 over 2024. So perhaps shaving 100 or 200,000 barrels per day off of that remains prudent, I think. With that said, we still think that a $70 base case remains very reasonable for calendar year 2025. For energy companies as well, what we're seeing is, even though we've seen the Canadian dollar rally as of recording by about 1.5%, differentials continue to fall. So that's the discount that we're getting for Canadian heavy and light versus US grades or US pricing. Differential right now for a Canadian heavy is about $9.20. That is at least a 4-year low. So that's helping buffer a lot of the weakness that we're seeing in spot price. So, we've had net length increase the past couple of weeks. So the financial demand for oil has increased. I think that has helped rally oil into the low 70s up until today, at least. The second news that we have to deal with is the news that OPEC Plus, or the voluntary members of the cut, are not only going forward with their intent to return barrels, but are in fact accelerating it. We learned that they announced beginning in April they would begin that. And today, as the market had to deal with the demand impact of tariffs, they announced that they're accelerating in the month of May and bringing forward a full 3 months of production as opposed to 1 month. Surprising. I will talk about why I think they did this. I'm still working on this, and we're expecting to speak to other parties. Optically, at least, I think the timing is quite poor. It helps corroborate the belief, which we continue to think is a false narrative, that the White House has successfully put pressure on Saudi Arabia, on Russia, and getting them to accelerate adding barrels onto the market to bring down price, which is deflationary, at a time when, whether the White House wants to admit it or not, tariffs likely are massively inflationary. So that's the narrative. And the actions on the surface would seem to suggest that there's legitimacy to those concerns. We still don't think that's the case. Some of our best sources so far, and again, this is a work in progress, are confirming to us that the White House did not, in fact, put additional pressure on the OPEC Plus members. In the communique that OPEC Plus voluntary members released, they spoke about the desire to retain balance in the market. Perhaps they're not getting it today, at least, but they did speak to strong fundamentals. OPEC Plus members, generally speaking, were more bullish on demand outlook last year than consensus. That remains the case this year. And so year to date, given the inventories that we're seeing, the demand statistics, the reality that we're seeing, combined with the very clear slowdown in US shale, even adjusting for the weather impact of freeze off, so it got very cold, there was production lost in the month of January. Some people that track real-time data are not seeing a very large growth beyond just recouping, wells coming from freeze and getting worked over, etc. And so I think the combination of those things, plus perhaps the desire to spank certain members such as Kazakhstan and Iraq, which have been cheating, I think perhaps this is meant to send a signal. Importantly as well, and I credit Brian Leeson at RBC for this, when you look at the actual paper barrels, or at least on paper, those barrels meant to be returned to the market, it adds to about 137,000 barrels per day per month. And so fast forward for May, accelerate that by 3 times, you're looking at over 500,000 barrels per day. That's a big number. Importantly, though, when you look at the countries and where they were producing in February, March relative to now the new baselines for May, it means that just increasing the baseline is basically just allowing the cheaters to become much more incompliant. So the net effect is the actual number of new barrels coming onto the market is much, much lower. We're estimating around 200,000 barrels per day. And so yes, that is loosening the market for sure. At the same time, it is accelerating the normalization of OPEC spare plus capacity, which remains one of the concerns that I think people have. So the concerns of the market today, very clearly, you've got demand growth worries. I don't think anybody can speak with precision to discuss the impact the tariffs are going to have. That is going to be very much a work in progress. The second concern people had was the ability of the White House to either talk down the oil price by exerting pressure on geopolitical partners or pick up the phone call, drill, baby, drill, etc. With oil at about $65 to $66, it is in the death zone right now in terms of production growth. Companies are generating enough free cash flow to pay the bills, keep lights on, keep production flat, but there is no growth at $65 oil, and that was confirmed in the Fed Dallas survey from a week ago when we spoke to that in our last weekly update. The third concern people have as well, geez, there's all this spare capacity held by OPEC Plus. And so it's our view that the next year to year and a half is a process of digesting OPEC Plus spare capacity, which we estimate at about 4 million barrels per day. Demand is roughly 104.5 to 105 million barrels per day later this year. And so as you bring down the 4 million number to, let's say, 2, that will become a less and less and less of a worry. We remain of the belief that U.S. shale twilight is here. U.S. shale growth would be significantly less than consensus believes, if there's any growth at all in 2025. We had a partner or a consultant, Flow, say they think U.S. shale will be peaking in the next 2 months. And they admit, short-term precision, maybe it slips a little bit. It's really the reality that the world has lost that meaningful unit of growth of short cycle supply. So we think non-OPEC supply growth will be peaking in the next couple of years. There's a growing call on OPEC and OPEC Plus members. They too have not been investing significantly new productive capacity, and so you eat through that spare capacity, and there will be a long-term mismatch between supply growth and demand growth going forward, suggestive of meaningfully higher prices. We're not there today, very clearly, and so we remain of the view that we'll average about $70 this year. We have a roughly 50% weight in our fund, or in the main fund, to natural gas. That is buffering some of the downside today. It likely is for any marginal dollar of investment, that's likely where we're going to be deploying it, with some uncertainties around oil demand right now, which will take a bit of time to work out. We have a situation where Canada, there was photographs of them receiving a unit of LNG to assist in cool down. We see first gas occurring in the next couple of months with a gradual ramp, ultimately increasing to 1.8 BCF a day. We have the same trend happening in the United States as well, combined with producer discipline, at least in the United States. And so we think a $4 to $5 trading band for natural gas is reasonable. And so we put the two together, $70 WTI, $4 NYMEX, a discount for Canadian gas versus US, narrowing as LNG Canada begins to ramp. What we have now is a sector trading at 12% free cash flow, extremely healthy balance sheets, and taking advantage of days like today where some stocks are down as much as 8% and buying back their shares aggressively. We had one of our largest holdings, it's a 10.5% weight of some mid-cap oil sand producer. In the month of March, they bought back 2% of their shares outstanding in a single month. That is the only upside, frankly, of depressed valuations of stocks at a time when free cash flow still remains very, very robust. And so thank you for your time. I appreciate there's a tremendous amount of uncertainty. We've done our best to add some element of clarity to that, but it remains obviously a very dynamic situation, which we all are trying to wrap our heads around. And so we look forward to our weekly update with you in next week's time. Thank you.